All right. Good morning, everybody. So we have been dealing with jobs data all week, and TGIF, it's Friday. It's the last bit of data that we are hopefully going to just get past all this and on to the next thing. It's a 3-day weekend, and it really seems, if we were to kind of draw that line in the sand of when things changed, it would either be last week or this week that when we look back, I think this is going to be the week or the last one. So hopefully we're going to see that reflected within the charts soon enough. Let's get the right screen here. Fed speakers Bosick, and then Bank of England Pill. Then we got unemployment data. Then we got Fed Miser and ISM manufacturing. Notice how that one just slid under the radar all week. That's usually a pretty good one all by itself. If we look at the anticipated impact for the week, you can see ISM manufacturing. It's a big deal. So not only do we have the potential for volatility because of the unemployment, later in the morning, we also are going to have ISM manufacturing, which, hey, that has its own punch right there. So when I say that today is a dangerous day, that's a little bit of an understatement. And it wouldn't hurt anything at all if you just didn't trade today. I'm not saying that you shouldn't trade. Looking at what's going on around the world, even with another stimulus measure this morning, although, all of these stimulus measures that China's been doing, they're not overly wow stuff, but they are loosening policy and easing policy. And yet this morning, they're still down 0.5%. Looking at everything on the screen, they're down the most. When we get closer to what is up this morning, the UK leads, and then the US. The Dow Jones first, then the S&P, then the Russell, and NASDAQ last. That kind of gives us a little bit of insight, right? The monsters of tech were just wow, right? And so it makes sense that they're a little tired after the run. All right, it's been a phenomenal week. I think we can just start with that weekly after I show this screen. I always want to get this screen in here. Mostly because if you go back and look at a particular day, I want you to be able to find this screen to see what was in there. 8:30, 9:45, 10 o'clock, and 1 o'clock. That rig count, don't worry about it. It's not often you'll hear me say that about a data point that we might be getting, but that one, don't worry about it. It'd be okay. So looking at this on the week, we had a TRB, and this chart on the right side is a weekly. TRB set up trendline breakover. While it has been a phenomenal week with the push to the upside, it has to be stressed that it really didn't go as far as a typical TRB would have. This is one trade strategy or one trade setup that I really like, because it is a high momentum, high move trade, right? That's kind of what you want, when you're doing a lot of options trades, things like that, is you want that momentum. Generally, this would have made it all the way to the top at least and pushed through that top even just a little bit, and I mean, sure, the week isn't over, but I don't know, it just came up a little bit short in my opinion. But still, the pattern holds true. The follow through has been phenomenal. And if there's any note of caution, it's this gap here, because that is a gap. It did not get filled. There's a number of gaps out there. Not all gaps get filled right away. They just get filled eventually. Like this gap way down there. Way. Right now we're focused most strictly on this data point that's coming in today. We can see the volume isn't light. They're not standing on the sidelines waiting for the data. So they've been in there trading, and they have been hedging because we have a market maker move. So we're inside day breakout, red to green, at least for the moment. Closing near the low of the day yesterday, and now up near the high of yesterday. Near the high, we're not there yet. Today we have the capacity for a liquidity gap, and I was hunting around for my liquidity gap pictures, but I've recently changed my organization system, and I think it's on a hard drive that I haven't pulled out yet. So I don't have the old examples primed and ready. We would have to just go find some on the chart, which isn't that big of a deal. But a liquidity gap looks very much like this that happened yesterday. This is a very minor one, but it'll be a good start to the conversation. So data comes out, you get that strong initial push, and then price comes back down to get the gap closed. Now, again, that's a really minor one. And on a day like this, we can have a really big gap. And I know you don't see a gap. For all you newer traders who say, what gap? I see candles there, man. I don't see no gap. I get it. You do see candles, but we're talking about a liquidity gap. Right? And gaps fill, especially this one. And this has a history of getting that gap filled by around noon. And it's a clean enough setup that when the setup isn't there, you just already know that don't worry about it. Like there's no trade to take, you're good, and you just let it go. You go do something else. Do one of our normal trades instead of that trade. So we'll throw it on 90 minutes and look back. I would try 180 days with 5 minutes, but I don't think it'll do it, right? It'll default and kick me into a 15-minute chart. So I think the May one, let's see how far back we can get. April, all right. April 12. Nope. May 10. Yeah, like that. Okay, this one's not perfect or pretty, but it gets the job done. So 8:30, data came out. We had a significant push to the upside, built some structure up here, and then it spent the rest of the morning getting that gap filled. Now, I know that might seem like I cherry picked a day, but I could only go back to April, and I couldn't get that April 12, so I went to the May 10. This is just one example. Does it always work? No. It doesn't always go up. It can go down, and it doesn't always work. So this is what a good one looks like. It'll be one candle, or it'll be a series of candles that are closing near their highs or near their lows if we happen to go down. Then it builds that base, it turns around, and it spends the rest of the time trying to get back down to where the data started, right? That's the gap close. So that's what a good one looks like. Now let's find one that wasn't good. I think the June 13 was a fail. So we'll just go to that. $15, $14, we're almost there. Yeah, I'd say that was a fail. Okay, so here's CPI for June 13. And we had this, now that I'm zoomed in, it doesn't look that big. The key though, to identify that this is one that you don't want is that it ran in both directions and then it basically closed right where it opened. So we just let that go. We throw the whole idea out the window and we just go do something else, because you're not going to get a gap close play if you don't have a gap to close, right? So we don't worry about it. You get 3 opportunities a month at least to do this, because there's always a CPI, there's always a non-farm payroll, and you could try it on, like PPI too, although that one's just fails even more often than these other ones. But non-farm payrolls is one of those events. It's one of those 3. So we have that capacity today. We need to get some levels on here. All right, so what we're looking at, what I just added on here, is the implied volatility for an intraday measurement. Volatility gives us an expected move. The math is a little complicated. It uses the square root of time and a couple other things. It's really not important how it's derived, just that we know it's consistent. And so what it marked out for us is this little cloud here. I want to just zoom in for a moment. This little cloud down here. That's the implied volatility move for today. And that's a really narrow range, right? Then beyond that, we've got this dashed green and red. Instead of the implied move, that's what they call the probable move. And then we get out beyond that, and we have our typical red line and yellow line for the ADR half and the ADR full. So that's a lot of different ways to define how far we could go. And then on top of that, we have a market maker move. So what this is telling us is that by the end of today, the S&P could be at 45.71 plus another $20. So that's 45.91. And we're not even compounding anything yet. This is all just what the math says we could do. By the end of the day, we could be all the way up there at that line. So let's take it in the other direction. And that's our range for today. That looks like a really big range, but I promise you it's not. I'm not reaching here, right? I don't have to. And it's not an either or. We could actually hit both sides. That's how these kind of things work. So that is a very large range from 44.40 all the way up to 45.93. Sounds a bit crazy, doesn't it? So it's really going to come down to if they're caught off sides or not, and if the data is in line with what they expected or not. How we close on the month is going to matter in the bigger picture. It's just not going to really matter for today. So you're going to want to revisit your monthly charts, your quarterly charts sometime over the weekend and kind of evaluate. And now that we've got this really big week, if we close the week in the upper portion, we want to mark out that 50%, right, of this week's candle and use that into next week. The expectation after all of this discussion about these lines and what we could do, the expectation is that we go into the end of the week, into this long weekend, having hold the line. That's like the base case. We're just going to hold the line. So we've had this nice turnaround. We've had this kind of nice recovery off of this pullback. Let's kind of put that into perspective. So, you know, you got a nice clean market trend, pullback, the deeper pullback, and now we're getting that drive up. If it just closes in the upper portion here, especially higher than that 10 period weekly moving average, it's going to be considered a good week, a really good week. So the benchmark on what it needs to do is really low. It just needs to hold the line. That's the base case argument for today, is that it holds that line. And if it starts to unravel, if you think about where these red lines are, they line up with that weakness on Wednesday after Tuesday's fantastic run, right? So we had that big blowout move, got a little weakness, and now we've just been holding the line for the rest of the week. So it needs to keep this, which is also the roundy 4,500. It needs to keep that. We break that and start heading to the downside, it's very likely that the rate of change will accelerate exponentially. Ten-day, 30-minute volume profile. You can see how in a very small amount of time, we've accumulated a lot of volume up there. I say a small amount of time, but the TPO does show, you know, we've been here for a wee bit. It's very likely that by Tuesday, when we come back in here, this point of control will be up here with us unless we break out of this zone that I have marked. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We do have a fantastic shallow area. So if we do break out of that red box to the downside, there's really nothing to help us out. And it should be a nice clean shot back down into these lower levels. Marking out the 5x5, we really don't have anything to mark from yesterday. We had a VPOC for a little bit, but it got taken out at about 4 o'clock in the morning, and there's really no reason to put it back on. If it was one that had been on there for a few days, I wouldn't take it off yet. I'd leave it on and see if we respond to it later in the day. But one that was as fresh as yesterday, we took it out at 4 a.m. We're done. It's good. That move through the kill zone hit it. So it stands out a little easier, right? The last few days after that run from Tuesday. All right, we got a new box, but first let's just deal with the box that we have for this week. So as you can see, we're outside the range. We've been outside the range since Tuesday. We're supposed to close in this box at least 80% of the time. That's 8 out of 10. And as we counted back earlier in the week, demonstrated we're not even close to that. Right now we're doing it at about a 50-50, and that's horrible. We could do better than that with a coin toss. Still, if we do begin breaking to the downside, getting back to the box is the preferred target, right? So if we get below 4,500, then maybe we can reach that box today. Either way, we got next week's box. The thing is, next week is a short week, so it's only a 4-week box instead of a 5-week box. And it's not set yet. We have to wait until the end of today, past 4:15, and then it's set. Between now and then, the gray line, which is the current price of the market, is moving up and down, and the green and red line are adjusting as that orange line, gray line, moves up and down. So while the market's awake and moving, this thing is still moving until 4:15. Everything stops. It locks into place and it stops moving at that point. We are at the cog line 45.31, by the way. So looking at the distance from the moving averages, we're at 1.1% above the 10-day. That is right around the average distance, right? We can kind of look back and, we've been higher than that, certainly. It's not a ceiling. It's just usually where the market tends to begin chopping about. Maybe it gets one more push, one more, maybe 2 more days, and then we get that little rollover. So it doesn't owe us one, but we are starting to get into that zone. And if we get past 2%, then we know we've gone too fast and that it's very likely going to reverse. But we're not into that yet. We haven't gone too far. We haven't gone too fast. We're not overextended. We're not overbought. And none of those kind of phrases fit here, at least on the daily. And here we've got the distance from the 10-week, 1.7%. We can see we've been farther away from the 10 than that multiple times before. And it's worth noting that when we do get that cross under and then we come back up, we generally have weeks where we do well before we start coming back to that 10 again. Right? We got the cross up, we had weeks, and then we didn't cross under and come back. We just came down and like tagged the 10. And then again, we had weeks that we were just doing good, right? So we have our cross up after having gone under the 10 and now back above the 10. It's no guarantee. We can see that there's been times where we've crossed up and then just failed right back down again. But more often than not, when we get that come up, cross up back through the 10, it lasts for 2 to 3 weeks. And if the S&P is running with that sort of momentum for 2 or 3 weeks, so will everything else. Yeah. And like I said, no guarantee top of this thing or we see the bottom of this thing. My bet is that we will see the top before we see the bottom. Yeah, the kill zone. I didn't name it I probably would have came up with, I don't know, maybe something that sounded a little bit better. The kill zone is a period of time between 2 and 4 in the morning. When they did this study and asked where was the greatest movement consistently throughout the 24-hour trading cycle, whether using a 1-hour metric or a 2-hour metric, the answer that they found was between 2 and 4 in the morning. The consistency of the size of the move there is bigger than the open. It's bigger than power hour. It's bigger than events. and it's more consistent, which is odd. So between 2 and 4 is called the kill zone. And it is statistically the place where you're going to see the biggest move of the day. Oh, well, then you're in the perfect time zone. Aha. I wish I could tell you who coined that, but I don't remember where I picked it up. The interesting thing is it's also tied right around that the European Open and all of that. So if you're in another time zone, what I tell people who are trading at night, usually earlier than the European zone, is like when I trade in the evenings, 7, 8, 9 at night, I listen to Bloomberg Asia. They do a really good job of giving me like a boots on the ground idea of how things are going, just like in our own market. What's our pre-market sentiment? How's earnings going? What's the mood of the market? And when I trade in the evenings, the Bloomberg Asia does a fantastic job. The morning Bloomberg here in America is a joke, right? It's an entertainment show, has no inherent value at all. But that Bloomberg Asia is fantastic, and you can get it for free. I mean, they're on YouTube now, so you don't even have to have a subscription. So there's really no reason today to go through and look at equities because it's not going to matter at all, right? There's no belief at all that anything that has managed to move up or down this morning is going to survive these economic events. So the data is going to be good and we're going to rip. The data is going to be bad and we're going to fall, that kind of thing. Although looking at earlier in the week, bad is good and good is bad. So if the data is bad, we're going to rip. And if the data is good, we're going to fall. That's kind of the expectation at the moment, because they're looking for anything that validates their belief that the Fed is done. They're not going to raise rates anymore. Right. And if we're getting bad jobs data, it kind of shows that they've accomplished their goal a little bit, and that's going to make the market happy. So there's no reason to go through and look at all of this stuff. It is interesting to note that we saw China was down, and yet the KWEB is up and the China ETF is up. EEM, which is emerging markets, and China is a large part of that. And I disagree completely. They don't deserve that status anymore, but whatever. That one's also up. The precious metals continues to push along with energy. We can see US dollar Japan, that nice double bottom. Remember, double bottoms are bear traps until proven otherwise. But if we continue to see this sell-off in US dollar Japan, we have the expectation of precious metals continuing to rise. So silver, gold, miners. We got the 10-year. Let's put that into a line. So we're still holding above 4%. But after that low set from yesterday, and we came up off of that low, we really haven't done anything else. So as long as it's just kind of holding the range and not moving fast up or down, we're good there. Bonds, unfortunately, are also holding that range. And if you look at the difference, we had the S&P started running here a little bit, and in the last 10 minutes or so, the bonds are starting to try to wake up a little bit. So it's not that dichotomy exactly of stocks versus bonds, but risk parity is not in effect this morning. Excuse me. And the dollar is holding. So everything is just poised, waiting for this data to come out. And that's why it's not going to do us any good to try to evaluate anything at this point. We just need the data. So I'll stress caution. Everybody enjoy your long weekend. Get a lot of rest, come back, and we'll see you next week.